Welcome. Okay, let's take a look at question 3 from 2013 July. It's a community property essay, very straightforward as community property essays tend to be. They lay things out, each individual item of property. Okay, so let's take a look at the call of the question. It says, number 1, what are W and Hank's respective rights in? Number A, the checks oil stock. Okie dokie. 1B, the restaurant. This is exactly how you want to write it out. Now, what I would do is you can either, write this at the bottom of the paper because there's room here, or you can just like make notes or just draw little arrows. Sometimes like I do that. I'll draw little arrows, for example, when I'm on the exam. Ron, if you want to zoom in real quick, one of the things that I tend to do is I'll just draw little arrows showing me what fact goes to what. That's my critical breakdown without being able to interlineate on the computer. So I just do a little arrow that shows separate property. Make a very little note, and you could do that like down here, whatever the issues are that you see, or through the fact pattern. And this way, you know, as each fact you go through each sentence, you're able to cross things out as you go. I find it to be very effective, and it helps with outlining. You don't have to write, I don't write a long, detailed outline when I'm going through this. What I see is I make those little arrows that you saw the one of them that I just started doing. So the restaurant, 1C, the rental property. Okay. And it says, number 2, to satisfy our judgment, may Kathy reach the community property, Hank's separate property, and or Wendy's separate property. Okay, so this has to do with debts. Question is whether the debt was incurred before the marriage or during the marriage. If it's during the marriage, the debtor's separate property is going to be liable, and all the community property is going to be liable. Goes without saying. So we have Kathy, debt to collect. She's trying to collect a debt. Okay, take it from the top. And again, if you notice, it says answer according to California law. Very few subjects are California specific. Only wills, community property, California evidence, and California civil procedure. PR is technically both California and PR. It's not going to say answer only according to California law. So you're going to look at really wills and community property, not trust. Trust is not California specific. It's general principles. And again, it says, look at how the fact pattern starts. In 2007, next paragraph 2008, third paragraph 2011. You'll see this pattern a lot in the essays. 2007, while married to Hank and residing in California, California community property law applies. No quasi-community property, no quasi-marital property issues. Pretty simple. When do you inherit it? $150,000. Well, they use that word a lot. Inheritance equals separate property. So the $150,000 is hers. And again, if you haven't read the fact pattern yet, read it 2 or 3 times, push pause, and then start listening to this, or you're going to be lost. Trust me, read the fact pattern a few times. In fact, it doesn't even hurt if you look at the model answer. It's totally fine. You're supposed to be learning from this. When you use the money to purchase $50,000 worth of check oil stock. So a change in form does not change the character of the asset. It's still separate property. So she used separate property to buy $50,000 of the checks. And a restaurant that cost $100,000. Okay, again, separate property, restaurant. Because she used her inheritance to buy the restaurant, and this, because it's now a separate property business, it's going to bring up Van Camp and Pereira. Because what else would they be getting at? Okay, and it's okay if you spell Pereira incorrectly. It's P-E-R-E-I-R-A. I actually spelled it right. Unbelievable. It says, okay, worth a check on a restaurant that costs $100,000. Hank managed the restaurant, and solely through his efforts, it prospered and is now worth $300,000. But it's her separate property business, but it's community property labor that enhances the value of it. So community property labor enhances value, and that's exactly what this is about, of a separate property business. So the community's got an interest, and because it's Hank's labor, they're going to have a pretty big interest in it because we're going to probably apply, guess which formula? At Van Camp, I always call it Van Character because it has to do with the character of the business. And for prayer, I always remember LMNOP, labor, skill, effort. Like it's just, to me, those letters just kind of go together. So I know with prayer, you're going to do a reasonable rate of return. In Van Camp, Van Character, I think about some lazy bums, somebody sitting on their bum that just happened to have a business that prospered. Well, it says his labor enhanced it because solely through his own efforts, it prospered. So that would mean we're going to be using Pereira accounting. And when we do the Pereira accounting, what you're going to do is you take a look at what the value of it at the marriage. So the value was $100,000. And now it's worth $300,000. So you do a reasonable rate of return. And you can just use 10%. It's totally fine. It's the standard number. Although I'd love to know who's making 10% on any investment. Sign me up with give me their card. So reasonable rate of return times the number of years they're married. Or the number of years they had the business. So they had the business in 2007. Looks like they're dissolving their marriage in, I don't know what year it is. But it's going to be from 2007 to whenever. That's going to be the number of years. And that is what's going to be the separate property value. Okay, we'll get to that in a minute. 2008, Hank inherited. God, these people aren't inheriting anything. How come I don't have any rich people that die? Hank inherited an unimproved lot in California worth $75,000. Okay, that's his own separate property. I assume that's going to be going to the rental property because we're talking about land. So again, inheritance equals separate property. Hank and Wendy obtained a construction loan from a bank for the purpose of building a rental house on the lot. Okay, now we're looking at a credit acquisition, and it's a credit acquisition during marriage. And that's probably, it's going to be a presumptively community property. But we're going to look at what the intent of the lender is. Who is the lender looking for payment? Who's going to be paying this back? Is he looking at Hank solely? Is he looking at Wendy solely? Or is he looking at both of them? We're going to find out really soon. In making the loan, the bank relied upon the salaries earned by both Hank and Wendy. And in addition, required that Wendy pledge the check oil stock. So the intent of the lender was both. So again, so this is a community property, debt, loan, credit, whatever you want to call it. So that's going to be community property, clearly community property, because the intent of the lender was to rely on both persons' salaries. And it said, in addition, required that Wendy pledge the check oil stock. Well, has she changed the stock from separate property to community property? Has there been a transmutation? And the answer, which will be invariably on your bar exam, no, because there's no express declaration in a signed writing by her saying that she's giving up any interest that she has in the stock and that she knows that a change of ownership is happening. So transmutation requires an express declaration, and the adversely affected spouse must know and somehow write that they understand there's going to be a change of ownership. Clearly, that didn't even come close to happening, so there's no transmutation. I can't believe the examiner snuck that issue in there, because you have to look really closely, and I think it's an easy one to miss, was that because she pledged the check oil stock, she changed, you can make an argument that she transformed her separate property into a community property debt. And that's why her transmutation comes in. I got to be honest with you, don't like the fact that they did that one, because it's easy to miss, and if you missed it, don't beat yourself up. You're going to miss things. You're not going to get published. You'll still pass. Trust me. You can miss things and pass. You just have to do really well on what you do catch. So make sure you do catch it well. You do catch it right. A lot of people had concerns about, well, because this restaurant was acquired during marriage, isn't it community property? No, because it was from inheritance. Remember, check the source of the funds that were used to acquire the property. And inheritance is separate property, and anything that derives from the separate property or changes, that's bought with separate property remains separate property. So the restaurant is a separate property business, and it brings up Van Camp and Pereira. And if you couldn't see that, when it says that Hank managed it solely through his own efforts, they're begging at you to get that. And they give you the value of the property, what it was worth when she bought it versus what it's worth now. That's clearly the examiner's getting at Pereira. Okay. A rental house was constructed on the lot. The present market value of the property as improved is $500,000. So it's worth $500,000. And this was based on the inheritance. So he put down $75,000 of separate property. And it looks like they put their money up. They used community property funds to improve a separate property, because this is his separate property. Now they're using community property payments they use to improve the property. I mean, she's unwittingly added to his separate property value. So what happens when the community property funds are used to improve separate property? Reimbursement. So whatever amount of money that the amount of community funds that were used to improve it, they're entitled to reimbursement. She could also make an argument that the community has proportional interest in this, but there's not really any facts to go to that. Even though it was $75,000, she could make an argument that this is kind of the down payment that they should be, that Henry, or his name Henry or Hank, that Hank should be entitled to reimbursement of the $75,000, and they should be able to get the appreciation there of $425,000, which should be split up community property, or percentage-wise. You have to do a percentage, which would be $75,000 into $500,000, which means the community would own an 85% interest, and that he would only have a 15% interest because his separate property put the down payment on the home, but the home's separate property, so that argument's probably not going to work. I do think they're going to at least get some kind of reimbursement because they had to pay off the loan, and the property's now worth $500,000. So essentially, Hank got a windfall from using Wendy's, from using community funds to pay off the loan. Okay. Where else are we at right now? 2011, Kathy, a customer at the restaurant, tripped and fell over a box carelessly placed in the entryway by Hank. So here we have a tort committed by one of the spouses, and here's Kathy. So tort, when was it occurred? It occurred during marriage. The question is, is his act a benefit to the community? If so, community property first, the debtor's second property, that's Hank's separate property, second. If it's not for the benefit, it's the opposite. So that means Hank's first, that's his separate property, community property second. As we can see, she tripped at the restaurant. What's the restaurant? It's her freaking restaurant. He's working in it. It's clearly for the benefit of the community. So therefore, when she obtained a judgment against Hank for the injuries, she'll be able to reach the community property first, Hank's separate property second. Hank and Wendy have now decided to dissolve their marriage. I'm assuming now means 2011 instead of 2013 because the fact pattern goes there. So when you do the Pereira formula, it's 10% return over 4 years, which means it's going to be $140,000, and that's the separate property value. And I think the restaurant's worth now $300,000, so 160 of it is community property. So that's how the restaurant goes. Okay. So let's do a recap real quick. The check oil stock, because she inherited $150,000, she used the inheritance, which is separate property, to buy it. It remains separate property. When she pledged it, it was not a transmutation because there was no express declaration showing that she's the adversely affected spouse. There's nothing in there that shows that she knows a change of ownership and that she's relinquishing all her rights in the stock. That did not happen. In terms of the restaurant, she used her money for inheritance to buy the business, so it's a separate property business. There was community property labor, even though it was Hank's labor, to improve a separate property asset. And because it was done by his effort, skill, his labor. Then you use the Pereira accounting, and that's how you come up with the value of the business times a reasonable rate of return over the number of years. So it's 4 years times 10%. It's $10,000 a year times 4 years. $140,000 is the separate property value, and the community should receive. Am I doing that right? Yeah, the community should receive property value. Hold on real quick, making sure I got that right. That's community's interest. No, that's subproperty value. Gosh darn it. Anyways, I'm getting the 140 and the 160 confused. So Wendy's initial investment of $100,000 will be assigned a reasonable rate of return. Over the 4 or the 6 years, you could say that's right. I did do it correctly, but I just used 4 years instead of 6 years. So that is the separate property when you do the reasonable rate of return times the 4 years, because had they not done anything with the restaurant and it got a reasonable rate of return, it would be worth $140,000. And that's just the money. If it was your separate property sitting in a bank account without you touching it, it would probably be $140 after 4 years. That's the reasonable rate of return. So in the model answer, it looks like I used 6 years because I assumed it was in 2013 when the essay was tested. Of course, it doesn't matter which date you used. Examiner should have been a little bit more clear on that. But I did do it right, which I'm happy about. Okay, so you'd use Pereira because it was effort and skill, wasn't the character of the business. No reason to use Van Camp. Although you bring it up, you explain what it is, and if you don't want to apply it, that's fine. You don't have to do the reasonable salary that a restaurant manager would get minus the family expenses, and that would equal the community's interest. Finally, we have the rental property. Hank bought the unimproved lot with inheritance, which again is separate property. But the credit acquisition, when they used money from the lender, the intent of the lender was to hold both of them. He relied on both of them in granting the loan. So it is a community property debt. You could say that community funds were used to improve the property. If so, then the community would be entitled to reimbursement. Alternatively, you could say the community property payments reduced the principal of the loan, which I think is actually it is a good argument. So then the $75,000 would be reimbursed. It wouldn't be reimbursed. Community would get a proportionate interest of $75,000 over $500, and the community's interest would be the inverse of that. So it'd be 15% separate property and 85% community property. And if you want to see how the math's done, just take a look at the model answer. It goes through it in a little bit better detail. And finally, Kathy's collecting of the debt because she was injured at the restaurant while Hank was working at the family business. She must first attempt to satisfy her judgment from the community property. And if that's not sufficient to cover the debt, then she may go after Hank's separate property. However, she may not, under any circumstance, reach any of Wendy's separate property, including the check oil stock, because that's hers, it's Wendy's alone, and because torts that occurred during the marriage or debts occurred in the marriage, the separate property of the non-debtor spouse is not liable. And there you go. That's a wrap for 2013 July question 3 for community property.